Ever pondered over the mystery of free cash flow and why it holds such significance? Well, you're about to unravel that secret today. Imagine a company as a complex machine, churning out products, services, and, most importantly, cash. Now, this cash isn't all up for grabs. Some of it is tied up in operating expenses like payroll, rent, and taxes. Some more is invested back into the business in the form of capital expenditures to maintain and grow the company's capabilities. But after all these outflows, there's usually some cash left over. This leftover is what we call the free cash flow. Free cash flow is essentially the lifeblood of a company. It's the cash that's truly free. Free to be reinvested in the business, free to pay down debt, free to pay dividends to shareholders, or even to buy back shares. It's a measure of a company's financial health and efficiency. The more free cash flow a company has, the more flexibility it has to enhance its business, making it a lucrative choice for investors. But how do we calculate this free cash flow? The calculation might seem a tad daunting initially, but it's quite simple once you get the hang of it. There are several methods to calculate free cash flow, but they all aim to arrive at the same number, given the information a company provides. The first way is by using operating cash flow. This method involves subtracting the company's capital expenditures from its operating cash flow. The second method uses sales revenue. Here, you would subtract both the operating costs and the capital expenditures from the company's total sales revenue. The third way involves using net operating profits. This method requires a bit more calculation. You'd start by adding depreciation and amortization to the net operating profit, then subtract the taxes and change in working capital, and finally subtract the capital expenditures. Remember, depreciation and amortization are crucial to account for the decreasing value of equipment and plants over time. So to recap, free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures. It's an indicator of a company's financial health and efficiency. Calculating free cash flow can be done through three methods: operating cash flow, sales revenue, and net operating profit. And it's an essential tool for investors as it provides insight into a company's financials, helping them make better investment decisions. Now that you're familiar with free cash flow, you're better equipped to analyze a company's financial standing and make more informed decisions. So go ahead, dive into the world of financial analysis with your newfound knowledge and see where it takes you.